One of the things that I get asked often by people approaching retirement is, should they change their investments? Hi, my name's Sally Boyle, founder of S.J. Boyle Wealth Planning, advisors to individuals and families who are anticipating retirement. So here's my advice to people who are approaching retirement and are wondering if they should make changes to their portfolio. First, I tell them to think about their retirement, to imagine it. What do you imagine you're going to be doing in the first year, the second year, 3, 4, 5, and beyond? And how does it compare to what you're doing right now? Do you imagine traveling, joining that club that you wanted to join but never had time for, visiting your family, fixing the house? And how would these changes affect your expenses? Will you need more money? Will you need less money? Then I tell them to look at their income sources, retirement income. How will it change? In my previous video, I talked about how to plan your retirement income, so visit it. But you compare your incomes to your outflows, and then you know what you might need from your investment and retirement accounts to supplement. This step also gives you guidance to your initial asset allocation, how much you should have in different categories of assets, cash, stocks, bonds. And for our clients, it gives us guidance as to the amount to be held in cash, bonds, and annuities. Low volatility assets. We call it their war chest because these low volatility assets help cover those cash shortfalls in their first 5 years. But it also gives us the opportunity to determine how much we want to allocate to other assets, to those assets that will be their inflation hedge. So then we seek to better understand risk tolerance, and you should as well. And the way you do this, you think about how you felt about your investments in the more difficult years, such as 2008 or 2020 or 2022. And as you approach retirement, you'll probably find that your risk tolerance typically decreases. So we tell our clients to remember their war chest, and they are covered for their first 5 years. And then they may be more willing to allocate assets to stocks and equities, those assets that are inflation hedges. But we still do gauge how much volatility they think they can stomach, because we don't want them panicking and wanting us to sell things at the times that the market is down. And we'll build a portfolio of asset allocation that we think matches their risk tolerance. And so should you. This is your job as well. Then there are tax considerations. Where should we be withdrawing excess funds from to minimize taxes? We'll have choices between pre-tax accounts, after-tax accounts, and we mix these withdrawals to minimize taxes. And that's important in using your retirement assets and your investments. When we think about taxes, we also consider where are the investments and where should they be. For example, those investments that generate taxable income, like dividends and interest, those should be in our retirement accounts, shielded from taxes. And our more growth-oriented assets should be in our taxable accounts, where we can manage the tax consequences of those investments. Tax-efficient income strategies are crucial to a solid retirement plan. Minimizing taxes is absolutely necessary. So we monitor on an annual basis. Has the portfolio drifted from its original asset allocation? Is everyone still comfortable with the plan, or do we need to make changes based on a desired change in return or a desired decrease or increase in volatility? And we also revisit the plan on an annual basis to ask, are we withdrawing a reasonable amount? Because longevity is a challenge. We understand that these portfolios must last at least 30 years or more in retirement. So it's essential that we plan for that. We recognize, and you should recognize, that your situation is unique, and it really requires a very personal approach. Your income is unique, your expenses are unique, your accounts are unique. So look for tailored advice to your individual needs. Don't listen to cookie cutter advice, the Dave Ramseys of the world, because your situation is too unique.